Hi, I'm Randy Cusick, a director on the institutional advice team at SEI. Today, we're going to talk about how pension plans are investigating opportunities to defease or reduce their pension liability. Defeasing is the concept of completely removing the liability and future responsibility from the plan sponsor. A recent poll conducted by the Pension Management Research Panel showed that pension plans are considering three primary methods to reduce liabilities: terminate the plan, offering lump sums to term-vested participants, or annuitization. This third option has been widely discussed recently and is where we will focus our attention. Our intent is to provide an overview and basic understanding, as in practice, these processes are both detailed and complex projects. Annuitization is when a portion of the pension liability is sold to an insurance company. This is commonly known as a buyout. Another form of annuitization is a buy-in, where certain liability cash flows are guaranteed by an insurance company, but the contract or agreement remains an asset of the plan. Today's buyouts and buy-ins are not new and have been around in differing forms in the U.S. as well as globally for many years. Generally speaking, plans look to annuitize retirees or pensioners in payment status. However, it is possible to include other groups, such as terminated vested participants, although this typically increases the overall costs. Before making the decision to annuitize pension liabilities, there are many factors that plan sponsors need to consider. The most basic are the ERISA considerations and the ultimate cost. First, annuity purchases must satisfy the ERISA safest available rules in order for the plan sponsor to meet their fiduciary responsibility in transferring the liability. Therefore, it is prudent to follow the Department of Labor Interpretive Bulletin 95-1 when selecting an insurance provider. Sponsors should also consider the cost, both the cost of purchasing the contract and the accounting costs that may need to be recognized. The cost to purchase an annuity contract includes 100% of the value of the liability being annuitized and a premium over the liability value for factors such as mortality risk, administrative costs, interest rate environment, and reinvestment risk and duration. It is not uncommon to see premiums of 15 to 25% over the liability value depending on the population and other considerations. Considering that over 75% of plans responding to the Pension Management Research Panel's annual LDI poll are between 70 and 90% funded, the premium required for such a transaction can create a very large hurdle. These transactions can also have significant impacts on corporate balance sheets. From a corporate finance perspective, organizations should also consider the view rating agencies may have with regard to the potential impact. Buy-ins were initially viewed as a favorable solution as they defer any potential accounting impacts while still immunizing a specific set of cash flows. However, risks with a buy-in still include a comparable high initial price, potential additional costs and due diligence may be required to change to a buyout at a later date or plan termination, the possible tracking risk to the liability, and the impacts on any current LDI strategy. Choosing the most effective approach to reduce pension liabilities is clearly a complex decision. The benefit of annuitization is that it defeases the plan sponsor liability, although maybe not entirely in the case of a buy-in. These strategies should be evaluated on a case-by-case basis, and at this time, we believe the environment is not conducive to making these strategies attractive for most pension plans. The selection and implementation process is long and complicated. Settlement accounting is still required, and most significantly, the expense can be significant premium to the liability value. We believe the current environment provides plan sponsors with better options for managing the plan's risk, with the effective use of custom and actively managed LDI programs and dynamic glide path management, eventually getting your plan to a funded level or environment of lower termination costs. Thank you for joining us today. If you have any questions or would like to discuss this topic further, please feel free to contact us.